Welcome, everyone. Let me get the slide share open so we can all be on the same page. Just be a second here. There we go. So, welcome to Unit 7. It's actually related to Chapter 8, Diversification. As I've mentioned kind of previously, as we're heading into our materials, sorry, let me get my screen to change here. There we go. Those first units really laid the foundations of strategy, of strategic thinking and resources and capabilities and markets and so forth. And then as we move into units 6, 7, and 8, they're really the complementary, the icing on the cake kind of topics where we look at specifically international market potentials, diversification, and then corporate social responsibility. So we're in the closing chapters built on that foundation of the first 5 units. So, just going to touch on a couple topics today. This will be a fairly brief lecture for us. And then I want to talk briefly about our assignments today. There's a separate video that goes into detail on our assignments this week. So, diversification, think about that from the perspective of your own maybe savings account, retirement account, investments. And that's that same diversification. So where if you have $1,000, you could take that $1,000 and invest it in a bank account and receive a very low level of interest. You could take that same $1,000 and go on Robinhood and open a stock account and buy some shares of stock in IBM or Amazon or whatever you might have. Or you might take that money and buy Bitcoin. So there's lots of different ways you can invest. But what diversification would suggest is don't take all of that money and put it in one place, spread that around. And the old adage of don't put all your eggs in one basket, because if you drop the basket, they all break. Maybe we should have that money, that investment in different things. So if one goes down, maybe the other doesn't go down and you won't lose everything. And that's similar with companies, because if we're purely invested in one market, one product line, one service, what if customer preferences change? What if a new competitor comes in? What if the technology changes? And suddenly we've had all of this history and investment and resources and capabilities, and the market goes away. So diversification for a company, as they've gotten to a certain level of success, is to consider, well, maybe we should take that additional profit we're making, and rather than just building more of the same expansion in where we are, maybe we should be doing a little something in other markets in case something goes horribly wrong in our existing market. So that's kind of the thinking of this, just to get your head in the right place. This is also the opportunity, if you think about a company whose market has gone really well, and you picture that market curve, that growth curve, and maybe, we've been growing and growing and growing, and now it's starting to flatten out because we've saturated our market. Is it time to get involved in a different market so that our shareholders have the potential for additional growth? So new opportunities. And then certainly, how about if the industry conditions have changed, as I mentioned, new opportunities, there's new potential out there. Think about even a few years ago, we didn't really have movie streaming services. We had video rental stores, and suddenly the technology between the internet and Wi-Fi capacities got to a point where we actually could stream videos. So that new opportunity came out and companies moved that direction. So there may be new things out there we can take advantage of. So just a couple kind of just like when we looked at our 5 generic strategies for a company, there are some, I'd say, moderately generic diversification strategies. And they come in some really high levels, and we'll cover a couple examples just to get your head into this whole diversification thing. So one is it necessary for a company to, or any organization to diversify? I'd say yes. If they're a growing organization, then they should always be considering whether we've just got too much internally invested. Should we hedge our bet and have some other things going on just in case something unpredictable happens? And so if we're going to pursue some type of diversification, what should that look like? And that's what these three get into. So one is, do you stay with an existing or a near related industry? So we know a lot about the industry we're in. We've got experience in it. We've got a brand. We've got a history. We've got a reputation. Can we just kind of stay with something nearby? And that way we can leverage everything we're doing and not be completely out into something we don't know. And quite honestly, in the 80s, diversification became quite a discussion. 1980s, it was a while back, 45 years ago. And companies were going off in really, really extreme diversifications that were so unrelated to where their expertise was, that they were just failing miserably. And so these companies were diversifying and spending billions of dollars getting involved, and then it all just went away and fell apart 2 years later, 3 years later. So we've come up with a little bit more of a balance, and that's what we'll get to at the very end here, of those 5 steps to evaluate a company's diversification strategy. But first off is this existing or near related industry. Um, I would say I would think about, before I jump to this next one, Keurig. Keurig's been in the coffee pod business for quite a few years. They grew out of the Green Mountain coffee business. They were a company that was in Vermont and just outside of Burlington, and they roasted coffee beans and ground coffee beans and sold coffee beans, just like a lot of companies do. And then they came upon the pod technology that we all know and love, and the Keurig machines, and they became huge in that. So that was kind of a near industry change, maybe just a product line change. But then more recently, they bought into a soda company, and I don't know the exact details, but if I recall correctly, it was Dr. Pepper. So it was a carbonated beverage, typical soda company, and Keurig bought them, and that would be a near industry. So it's still liquid, it's still beverages, but they are a completely different animal compared to sending pods and packaging pods. And I've been to their facility in Burlington and actually seen them doing this. It's just an amazing operation. But I've also been to bottling plants. I visited Gatorade in particular, and certainly many, many large scale brewing operations. And so the creation of a liquid beverage in a container like beer or Gatorade or soda is completely different than pods. So I would call that a near related industry. You could enter a completely new industry, and I'll touch on Honda as an example. Honda's known for their cars. They probably go back into the 50s or 60s as a Japanese car manufacturer. But nowadays, Honda has expanded to, I would consider, a new industry: lawnmowers, generators. They actually make engines for small airplanes. So while you could say that's kind of related, but I would consider that to be a new industry. It complements their existing knowledge. They know how to make engines, but the engine that goes into an airplane is completely different from the engine that goes into a car. Um, they leveraged current resources and capabilities, so it was logical steps. They didn't go out and do something totally crazy. They extended themselves, and have been extremely successful in these other markets. And you could do both. You could do a little bit here and a little bit there. And this is another term that's not used in our chapter. It should have been. And I like to use the term portfolio. Just like an investment portfolio, a company should be looking at their combination. And some of these are large investments, and some of them are small and growing, and some of these are shrinking. So there should be a whole array within a successful company's portfolio of engagements. The other thing to keep in mind is that when you have a portfolio like that, is you also need to divest or undiversify, which is not really a word, but to divest means to sell off. So if you got involved in Dr. Pepper as Keurig and it worked for a little while or didn't work, and you say, we tried this for 2 or 3 years, we thought it was really going to turn into something. And honestly, what Keurig's intention was with it, I had to ask when I was there because it was a little bizarre. I said, "What are you guys really up to?" And they said, "Well, what we're thinking was these Keurig machines are so popular that we believe that we can create a similar machine for on your kitchen counter, and then you can make on-demand soda. And I think you've seen those machines now being advertised on television, and that was the kind of brainchild of Keurig. I'm not sure that they're the ones that finally brought it to market, but that was the concept that you would make fresh soda with your own fresh water and then that mix, and you would carbonate it right there on your counter and just make a glass of it. So if that doesn't work out the way you think it is and you could use your money elsewhere, then you divest, you sell it to someone else. So bottom line on this thought in diversification is the whole goal is that we're doing something to increase the value of our shareholders. So I didn't use the term stakeholders here because stakeholders are your customers, your suppliers, your employees, it's everybody. Shareholders are people that really have a financial stake in the company, and they make money based on how well the company does. So and this has become a challenge for some companies because they generate so much cash. A company like Amazon has been incredibly successful and has large reserves of cash. Coca-Cola is probably another one. Largely successful companies. And if you have that cash on your balance sheet, it's just sitting there literally in a bank account and it's drawing, 1% interest, 1.5% interest. And if there's millions of dollars in this, then as a shareholder, as an owner of the company, my question is, could you do something better with the money that would make more than 1% at the bank? The other item is that if you're carrying that amount of cash on your balance sheet, you become subject to takeover. So another company who needs cash might be looking, going, I'm going to take over your company, a hostile takeover, because I can use that cash and make even more money for your stakeholders. So that can be risky. And that's where we see companies like Amazon who have gotten into content development. They're actually making movies and shows, weekly television shows. They got into AWS, the Amazon Web Services. So they had so much money that they needed to invest it in good things, and they keep just investing in incredible things and making even more money. So good diversification for them. But that's the concept, is the shareholders are looking at this and going, hey, what are you doing with that money? Because if you're not using it to make me more money, then somebody else will. So there's three kind of things is if we should be doing diversification. First off, is there something better to do with it? And number one in the list that's provided is the industry attractiveness. Is what you're getting into an industry that's really going to be successful? Are they going to be growing? Is there too much competition already? Is it something that we can really make money at, or is it something we just don't have any expertise and we're going to lose money in? The number two is the cost of entry. If you remember way back to units 1 and 2, we talked about barriers to entry. So what's it going to cost to get involved? You think about Amazon and getting going with Amazon Prime, right? Where they came up, they're using some kind of technology platform to provide streaming, and then they turned and they started making content. So what's the cost of starting to make content? Well, you need studios, you need cameras, you need crews, you need actors, you need actresses, you need editors. The cost of getting into the content development business in theatrics is incredibly high. And the question is, if I'm going to invest those millions and millions of dollars, can I really still make a profit? So just good questions to be asking. Finally, the better off test, and this is the one I alluded to earlier, is there something else we should be doing? Maybe we should just be buying Bitcoin rather than making movies. Maybe we should buy Rivian and go into the car production business. Maybe we should buy Tesla and go into the car production business. Should we not get into creating content for live streaming services? So just three general rules of thumb. They're just good things to think about of when we're making a decision whether to diversify and how to diversify. We're going to get into a little more detailed version for the discussion question this week. A term that comes up and it gets often misused that I wanted to just touch on for a moment is this economies of scale versus economies of scope. And I've seen people use these interchangeably, and they're really two different things. They do have to do equally with improving efficiency. So they're both good things. But economies of scale is something that we discuss usually in an operations management course. And the concept is that as we increase volume, so economies of scale is all about volume. If we increase the number of units we produce, does our unit cost of production go down? So if I'm a home brewer, or sorry, if I'm a brewer and I decide to make beer at home, it costs me to make that. When you do one of those home brew kits, it makes like 3 6 packs worth of beer. So 18 beers. The cost per unit is very high because I need to buy the raw materials. I need to buy the equipment, the bottles, the so forth, the caps, and all of that kind of stuff. And I need to take my time to do all this, and then I end up with 18 beers. So each of those beers ends up costing me like $4 or $5 each. Whereas if I went to a larger operation and I was using larger kettles and I was producing multiple cases of beer, then that unit price of each individual beer can might go down from $4 to $3.50 to $2.50 to $1.50. And I would argue a company like Budweiser, who's producing tens of thousands of kegs of beer per day, that their cost per can of beer is probably about 25 cents a can, and maybe even less than that. So by having greater volumes, you achieve efficiencies. So when I say economies of scale, it's really economies of volume. Economies of scope really touches more on what we're talking about here with diversification, because scope is expanding the range of things we do. So rather than just making beer in cans, I might make beer and pretzels and chips, very related. I may make beer merchandise. So that would be scope, where I'm expanding the types of products and types of businesses that I engage in. And there are efficiencies in that, but it's not based on the volume. It's based on the opportunities to bring in revenue from other sources. So not the same customers all the time, not the same product line, just more of it. It's the potential to sell into other industries. So a little different thing. So be careful. Those two terms, just keep them separate. Just for your career wise, when you're talking to people, just make that distinction. All right. Now this is the kind of the coup de grace of this chapter. And I'll wrap up with this. I'm going to give a very high level because this is the topic and it comes right out of the text chapter. And this is the title, Evaluating the Strategy of a Diversified Company. So you'll find it when you look through the textbook, and they provide 6 specific ways to evaluate. And this is what the discussion question this week is asking about. So it's asking you to look at a specific company and then use these 6 lenses to look at what they're doing in diversification. And I'm only going to provide a really high level. I'm only going to do these 6 bullets. There are multiple pages in the textbook on each one of these. So they talk a lot about each one. So you'll be able to find plenty of information to dissect your company for the discussion question this week. So number one, we've talked about from many different angles, industry attractiveness. So when I'm considering diversification, or if I have I diversified into industries that are really good? Are they growing in market that I could actually capture revenue there? Is there not enough competition or too much competition in that market? What kind of costs am I going to face? And when I say cost, that's because based on the cost that I'm going to face, that's where my margin's going to be. So it could be, I probably should have used the word margin rather than cost. It could be a high margin market, which means I can invest very little money and sell those products for a very high number and make lots of profit in that area. So how attractive is that industry? Number two, competitive strength of me. So if I get involved in that market, am I going to capture a significant portion of the market share? And I'll use a reference. I can't remember which company I was talking to, but they were into diversification and new product development, and they said, we will not engage in a market or stay in a market unless we can be number one or number two. That's a pretty high bar to put out there, but it was been very successful for them. So they only if they're going to get into a market and they go, yeah, we'll do okay, we'll be number 3 or 4, they won't go. And if they're in a market and they get pushed down to 3 or 4, they divest. So it's a very aggressive strategy, but they only stay in markets where they're incredibly successful. The other questions in this high level would be relative cost. So relative to my other competitors, are my costs going to be competitive, or am I going to be too high or can I be low in that market? And then how well will my reputation, my brand play in that market? Like I think of Tesla, and not that they're a model company right now, they're dealing with a lot of issues. But if Tesla was to announce a product and it was a flashlight, and I'd see it on the shelf in Walmart, I would probably buy a Tesla flashlight because I'm thinking these guys know a lot about batteries and they know a lot about recharging. So a Tesla flashlight ought to be really good. So would that brand you have extend to other markets and do well for you? Other things, like if I saw pita chips on the shelf in my Acme and they were Tesla, that wouldn't win a lot of market for me. I wouldn't look at it and go, wow, pita crackers. I bet Tesla makes a killer one. No, reputation would not do you any good there. Strategic fit, we've talked about before. So what of the five generic strategies, which one are you using? Is that something that you will be able to use in this new market, or will you have to go from differentiation to low cost, which can really low cost in this new market that can really screw up your branding, your reputation, and et cetera. So something to really consider. And again, if you think about Apple, Apple has expanded into lots of different product lines. Um, uh, Even um, non-tactile, technologies even. And when you see that Apple name associated with it, you kind of say, "Oh, that's right," because they do high quality, broad market, differentiated products. Whereas if they came out something that was low quality, if it had the Apple name on it, that would confuse your client. So resource fit is what we're doing. Can we somehow leverage it? Financial things like our cash flow. Do we have something like Amazon where it's a cash cow? That means that the Amazon retail sales are bringing in so much money, we can afford to take that money and invest in a resource high required market, like Amazon Prime, like AWS services, high cost, questionable returns on that. Non-financial resource fit would be more about how my brand fits that, how my knowledge and my expertise. So honestly, I'm a little surprised to see Amazon getting into AWS and Amazon Prime from the streaming service standpoint, because their expertise was in listing stuff for sale to sell to retail clients and warehouse it and deliver it to my home quickly. So it made sense when they got into Whole Foods, but I was a little surprised when they got into AWS and Amazon Prime streaming services. But they had such an amazing amount of um, cash to spend, and their reputation was good quality, low cost, and kind of worked. Ranking performance prospects from each business. Now, this is kind of a little twist. So this one's not as, it doesn't fit as well with the other four. But what it's suggesting is that a company needs to look at its portfolio and understand how those multiple engagements, diversifications fit together. How does AWS and Prime and Amazon.com all fit together and work in sync? And let's rate those and put in a ranking system that says, well, this is our number one because this is really where we make all our money. And this is where we're always going to make all of our money. This one's good, but it's not as good. And this one's kind of a lost leader for us. And this one's something we need to consider getting rid of. Because knowing the rankings from best to worst, that then when times get tough, or if you say, oh, there's this new opportunity, should we get into it? Do we allocate resources to it? Do we sell one of those off? What do we do? So that's just kind of the thought process on this. The sixth one is plan for overall corporate performance. This is as an outcome from the ranking. Now, what do we do? Do we invest more in this one? Do we push this one out? Do we add another one in to complement that? How do we make those work together? Again, thinking back to shareholder value. How do we make sure that we're getting the very best return on investment for our shareholders? And that's by mixing that up. And you see, if this is not as a popular a company, but General Electric was huge in diversifying. And this was back in the 80s. The guy that was running it was called Jack Welch. He would buy stuff like crazy and he would sell stuff off like crazy. People I would meet professionally goes, yeah, I work for General Electric. And then 6 months later, like, yeah, I don't work for General Electric anymore. They sold us to Raytheon, and now I work for Raytheon. And then it was just insane back then. Lots of instability, no loyalty in the employees. But what GE had shown was that it was almost like they were buying and selling stocks on the New York Stock Exchange. They saw a place they could make money, they bought it. They got what they could out of it, and then they sold it. And it was just a tumultuous time. Not something we quite see these days. So I hope that gives you some of the majors for that. Those six, though, are really important. Please draw on those for your discussion question. So I'm going to stop there with any content. The chapter is huge, and it's interesting, but we're not really going to draw as much out of it as what I've just covered. So, any questions? Watching the chat because I'm just gonna, kind of call it here. I'm gonna do my office hour as scheduled this week, but I wanted to make sure I here the first day of the unit 7 got as much information out as possible. I'm also going to pitch. I did a separate video discussing the discussion question for this week. What I just covered here, not in quite so much detail, but more importantly, the assignment. We don't really have an assignment this week. The assignment is to get ready for next week. That's a big one, and I want to make sure people understand that. So I made a separate video and sent the link out to that through the announcement. So make sure you look at that. I'm gonna stop sharing my slide, get my mouse to go back here. There we go. Oh, sorry. I see now I do see there's a chat. You're all good. Okay. Thanks for the chat message. I'm gonna cap it here so that our video is a reasonable length. Maybe some people will choose to download it and watch it. But then feel free to message me back separately or catch me on the office hour this week if you want to dig into anything deeper. Okay?
Okay, thank you.
All right. Take care.
You too.